Welcome to another episode of Rich Dad StockCast, the podcast for people serious about improving their financial education. I'm your host, Denney, and today we're tackling a topic that often is seen as a gateway to wealth, and that's investing in index funds. Now, index funds are often praised for their simplicity and low cost, but are they really the easiest path to wealth? Well, we're here to uncover the truth and give you actionable insights to make informed decisions. Now, before we dive in, don't forget to like, subscribe, and share your thoughts below. Your feedback always helps us to bring more of that content that you want to hear and that you care about the most. And for free educational resources to supercharge your financial knowledge, head over to stockcastbonus.com. Now, joining me today is none other than Rich Dad expert Andy Tanner. Andy, welcome back to the show.
Man, I'm stoked for this topic, man. I mean, you are picking some great topics to discuss. I don't know if you're getting them out of people's comments or where you get them, but this one is such a great topic. I'll probably spin it a little bit different than people expect, but it's going to be a great episode, man. I can't wait.
It is. And we do pull these topics from our comments. So again, listener, please add your topics there. It helps us to see what you want to hear. So anyways, Andy, index funds, they're often marketed as the go-to investment for beginners and seasoned investors alike. Let's start unpacking this a little bit. Andy, first off, what are index funds? Let's start there.
So an index fund is, it's not someone who's going to go out and try to pick stocks. You know, those are called actively managed funds, where people actually go out and they'll put together a mutual fund where they'll pick stocks and do research. An index fund is where you're going to tie it to an index. And some popular ones, most popular is the S&P 500 index, where you're going to buy the good, the bad, and the ugly, the best and the worst. You're going to buy, it's a diversification play, and you're going to believe that the market will ride you up. So you've got, you know, the NASDAQ index funds, you've technology index funds. You pick some, you can have an index on precious metals, and you take an average, you know, you have the Dow Jones Industrial Average Index, where you take 30 big companies that are, you know, have various sectors, and it's a very diversified approach. It's a very broad approach that speaks to a belief in general growth and belief in general business, either nationally or globally. And so it's less of a deliberate thing and more about just participating in the broadness of the market rather than being on the sidelines. So I have strong opinions about them, but that's what they are essentially.
How do they compare to like mutual funds? Maybe a beginner investor, they're like, well, what's the difference between that and a mutual fund?
A mutual fund could be an index fund. A mutual means that there's a group of people investing, like mutual insurance, right? You know, you hear that word, Mutual of Omaha, right? It's a mutual deal. So a mutual fund just speaks to a bunch of people who are going to gather and put their money in this together. A mutual fund could be an index fund. The Vanguard has a mutual fund called the Vanguard 500. You have an exchange traded fund, which is different, where it's set up differently, like the QQQ is a ETF that invests in the NASDAQ. The SPY is an index fund that invests. So it's really not about whether it's an ETF or a mutual fund. It's really an index fund refers to what is being invested in. And so you start with there, which means fees. These fees should be among the smallest of any possible fees you could possibly pay, because there's zero intellectual prowess required to pick these. You're just following whatever the S&P is. You're not predicting up or down. You're not selecting anything. You're not discriminant. There's zero brain power in buying the S&P. You know what they are. That is, you go buy them yourself. It's just a convenient way to get exposure to that index. There's no genius or any type of intellectual prowess you're paying for. So your fees should be among the smallest. And at Vanguard, they are. The Vanguard 500 is, as close to free as you can get. There's still a fee, but it's not something that you should be paying a lot for an index fund.
What would be the drawbacks of an index fund? I mean, low fees sounds great.
Lots.
What's the drawback?
So this is where I'll probably pivot a bit. This is very typical of the discussions I'm drawn into all the time, because what happens is the topics on most podcasts, including ours, tend to be about investments. In other words, you'll say, Andy, let's talk about options today. Or Andy, let's talk about gold today. Andy, let's talk about Bitcoin today. And what happens is we begin to talk about investments rather than investors. And that's backwards. It's backwards every time. To say, is an index fund good or bad? You're talking about the wrong thing. Is an index fund a good idea or bad idea? You're talking about the wrong thing. What we really, to really get the understanding of where index funds take a place in someone's life is to talk about the investor, not the investment. And that's quite a discussion, actually. To say, are index funds good or bad? You can't say that because you have to take in consider. For example, what's better, the piano or the guitar, or what's better, playing the piano or playing baseball? You have to take the kid into consideration when you talk about those things. It's all
That's a
about
great
the
analogy.
person, not it's about the person. So let's back up a little bit and let's talk about Warren Buffett. Does Warren Buffett buy them? That's a great question. If he does, why? If he doesn't, why? And I've studied Warren Buffett intensely. I think if I'm going to be in the world of paper assets, who are the best at it? Guys like Jim Simons, guys like Warren Buffett. What do they do? How are they different? Why do they have such different paths between Simons and Buffett, right? Where Simons has beat him, the late Jim Simons. And so let's talk about Buffett for a minute. When Warren Buffett speaks, if you study him enough, at least what I've discovered is there is a line where he separates sheep and goats. He really does. There's a line when he speaks where you can tell he's either talking to the uneducated investor or he's talking to the educated investor. And there's a huge frequency in which he'll talk about people that don't know what they're doing. People that don't know what they're doing. He says that, late Charlie Munger, these people don't know what they're doing. So he's very, very aware of the investor as opposed to the investment. And so, for example, you can find clips of him saying diversification is an answer to ignorance. Well, that's exactly what an index fund is. But you can also go to Omaha back when the late John Bogle was alive, and John is in the arena at the meeting. The Vanguard founder, John Bogle, before he died, and Buffett pauses me. He says, "I'm here to give tribute to John Bogle, who's probably done more for the average investor." Catch that. Than maybe any other person by saying, look, just buy the index fund. And Buffett often gives the advice, buy the index fund. But you have to know that in every single instance, he's talking to the uneducated. Every time. He doesn't put his wealth in index funds. He doesn't see any sense in it. He says, if you have 30 stocks and you distribute your money evenly with them, that's simply confession that you don't know what you're doing. Why would you allocate an equal amount of resources to number 30 in your list of attractiveness instead of weighting it towards number 1? He says it makes no sense. It's confession that you don't know what you're doing. Another problem with index funds, if I could just go into this, I can hear Robert Kiyosaki screaming in my ear saying, Andy, stay big picture, don't get granular. So I hope this isn't too granular. I hope this is still a big picture concept. There is something called the Shiller PE index. I was speaking with some of my colleagues about this in a separate podcast earlier. And the Shiller PE measures the S&P 500, that index, from 1871 to today, and it weights it based on inflation and keeps it in line. And we're paying more now. There's only been one other time other than now that we've paid more for stocks, that index. So if you look at the S&P as a cash flow jack in the box where you do the work and turn the crank and the money pops out, how much are you paying for that machine? You're paying $39 for $1 of earnings right now. So if you want to buy an index, be my guest, but realize you're paying more now for that. You're not buying it on sale. You're not. You're not buying it on sale. So the idea that I'm just going to dollar cost average and buy this all the time means that you're willing to give up the efficiencies of buying on sale, and you will pay top dollar. It is fascinating right now that money's leaving bonds. The greed is insane, and the lack of fear right now is insane. We were talking about this in an earlier podcast. People are selling bonds at a discount, solid guaranteed return from a government bond. They're selling them for less than the original purchase price. They're giving up relatively higher rates of interest than they got years ago in order to buy stocks at the highest prices you've ever seen them. Crazy to pay that much. So, that I have an issue with that with the index fund is I don't want to smart investors. Buffett has a mountain of cash right now, a mountain of cash, hundreds of billions of dollars, $200 billion, hundreds of billions of dollars in cash right now. Why aren't they in the index fund? Why didn't he deploy that capital right now? If that's a good idea, why isn't he deploying that capital in American business, which he believes in right now? Because it's too expensive. It's not strategic. It's not smart. He's going to wait until the thing goes on sale. Now, what he probably is doing or has done in the past, he's so big now, it's tough for him to do it now, but he used to. Like if you go back 20 years ago, 17 years ago, 2008, he'd sell a couple $1 billion. He can't do it with 200 billion, but he collected $2 billion in premiums that year by selling puts on these indexes, betting they'd go down. So he wasn't buying them. He was promised to buy them if they crashed, if they went on sale. So you look at a guy like Buffett and you say, he's not buying it at top dollar. He's selling a promise to buy it if it crashes and buys it cheap. To me, that's insightful. To me, that flies in the face. You get a guy, I don't want to bash I won't name names like Dave Ramsey, but these guys they're disciplinarians. They're not creative. And they assume people are stupid, that they can't learn how to invest, that they can't learn to be strategic. Oh, you can't beat the market, blah, blah, blah. So just buy the index fund and dollar cost average. Well, that's not what Warren Buffett does. And if they want to say, well, everyone isn't Warren Buffett, I'll say I would agree. But you will see Buffett absolutely make that delineation. He always talks about people that don't know what they're doing. And buying an index, loading up on an index fund at the market high, at a PE, a Schiller PE of 38, that's about as expensive as you get if you look at it from an earnings standpoint. So there's long-windedness as always on Andy's part, but that's why I'm not buying index funds right now. I'm not paying that. No way.
That makes total sense. Well, let's do this. We just scratched the surface of index funds, their pros, their cons, how they can influence investment strategies. So when we come back, Andy will reveal some practical steps to help maximize your returns. Stay tuned. You don't want to miss this.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Welcome back to Rich Dad StockCast. I'm your host, Denney, and we're here with Rich Dad expert Andy Tanner, diving into the topic of investing in index funds. Now, before we continue, a quick reminder to visit stockcastbonus.com for free tools and resources to help you on your financial journey. All right, Andy, let's move from theory to action. We understand index funds a lot better now. We understand really more the cons of them, I would say. Where does the average investor go from here? We talk about the average investor. I don't know about you, but I don't want to be average. So where do I go? What do I do?
See, if I were to give counsel to the average investor, it would be don't be average, go learn some stuff so you know more than the average person. That would be right there. I think it's a lot like 401ks. 401k stink. They're awful. You're the last place guy of all the players in that world. The government, Wall Street, the corporation, and the employee. Those are the four people who live in that world, basically. And the employee comes in last. 401ks are a great deal for corporations. And I feel the same way about index funds. If you want to be ignorant and you don't want to learn anything, probably better than doing nothing. At least you're buying some asset. If a person went through and spent, let's say they put away $500 a month in an average household, something like that, and they bought the S&P at $500 a month, and they did throughout their life, they would become wealthy because even though they're buying a high, they're going to have ups and downs, but it's not nearly as efficient if you were discriminant, right? If you were really smart, like Buffett is, and you buy dips instead, and you buy value instead of autopilot. Buying value makes sense. Price is what you pay, value is what you get. If you always pay the price, intermittently, you'll get some value intermittently, but it will not be as efficient as a person who has the four pillars of investing, starting with a basic understanding of fundamentals. If you're going to be a good athlete, learn the fundamentals. If you're a baseball player, you got to hit, you got to catch, you got to throw. If you're a basketball player, you got to dribble, pass, and shoot. If you're a football player, you got to know how to tackle. You have to know how to tackle if you're going to play defense. So the fundamentals are essential to efficient investing, and to jettison education from your life, it's never a good idea to be dumber, ever. But if you're determined to be that guy that says, look, I don't want to mess with it, it's great. Buy an index fund, better than nothing. The pros to it is it's brainless. If that's a pro, they're convenient. You buy them. It's not a part. You're now saying that I'm going to give up on learning this, and I'm just going to hope that the market always does well. Now that can be a problem like it would have been for my father, who retired in 1999. And then you have a decade of nothing. And so you spend, half your retirement with your balance dead and killed. So it can really hurt you in moments of crashes if those crashes are prolonged. Never going to hurt you when you're 12 or 14 years old, but most people worry about this are 60. And so there is some worry about paying so much. And then they say, well, move to bonds. Get out of equities, move to bonds. Well, yeah, that's only because of risk. That doesn't give you any money, though. It's not effective. So it's a real problem when you decide to say, look, I'm just going to be an index fund guy. If you did it from a young age, it would work. But if you start when you're 60 doing that, look at what you're paying right now. And so investing for the long term works when you have a long term and you're, like my sons, you're teenagers. If they wanted to buy, they'd never do it, but they could buy an index fund. The thing I like about the exchange traded funds for those kind of in the middle is at least you could write some options on it, where you couldn't do that on an index mutual fund. But on an ETF, you could write some option premium on that and add to your cash flow. So for the average person, I'd say don't be average. And that's not who's watching this, I hope. I hope you're not average watching this. And I want to be average. I think I'll tune into the StockCast so I can be, middle of the road, right? So I can be average. That's not who we are. We're here to be the best we can possibly be. And that means education.
So let's do that. We've kind of done the good, better, best. Good index funds, better ETFs, best financial education. I'd like to revisit the four pillars because I think it's worth revisiting. Can you speak to our audience? What are the four pillars?
The four pillars of investing came about because of Kim Kiyosaki and because of Robert Kiyosaki. When Robert approached me, he said, hey, I'd like you to, I spent 14 years when we traveled a lot as the advisor team. Haven't done that much since COVID. But I will tell you that he said, you need to write a book in the series. And I wasn't just humbled, I was petrified because I'm not a writer. or at least I wasn't. I guess I am now. I'm not a good writer. And so it forced me to organize what I thought I knew about investing. And that certainly evolved. But I did believe there were 4 things that everything I learned in any asset class, whether it be the cash flow game all the way to gold and silver, every asset class has 4 areas that you would study. So those 4 areas became what I call my 4 pillars investing. There's other people have their 4 pillars or 6 or 3, or whatever, but I have 4. And these are the areas of study that I think encompasses financial education. Number 1 is fundamental analysis. That's a fancy jargon that says we're going to look at something carefully. Analysis means we're going to look at something carefully. Fundamentals are the stuff that's important, that need to be there. So in basketball, it's dribble, pass, and shoot. In the piano, it's learning your scales and your fingering, right? Every single task. In surgery, I'm sure there's fundamental things like cleanliness and keeping things sterile. There's just certain fundamentals that have to be there. So when we look at fundamentals, we're really looking at the strength of the entity, whether it be a business, whether it be a household, or whether it be a nation. They all have financial statements. And the ability to take those financial statements, read them, and interpret them gives you a bit of a not a great crystal ball, but I know whether you suck or whether you're doing well by looking at your financial statement. So you can evaluate the strength of a business. Does it have a moat with fundamentals, and find value often where we say, wow, fundamentally this is strong, but there's a detachment because of emotions of price. Or maybe like now it's the other way, where prices for some stocks are way overpriced compared to how solid they are fundamentally. So fundamentals is the first thing. You're not going to do that with an index fund. You're not going to do it. You're just going to buy. That's it. So you remove the ability to analyze what you're buying when you do an index fund, because so many companies in an index fund are going to have various financial statements. You're removing your opportunity to discriminate based on fundamental performance. You're buying the whole NBA, including the bench warmer that never plays. So you're getting LeBron, but you're also getting the guy you never heard of. You're buying the whole NBA rather than the all-star team. It's that simple. How do you pick an all-star team? Stats. We'll look at their stats, watch their film, see where their fundamentals are. 2, technical analysis. Technicals help me a lot with pricing when I buy, but for me, I care more about the range of price than the direction. So technical analysis helps us get a little insight on trends and where things are headed up or down, but it's far more important for me to see the range than the direction. So we want to study the emotions of the market. We want to study where people are buying and selling at. We want to have an understanding. So where fundamentals is more about the entity and the asset, the technicals is more about the emotions of the buyers and sellers. Those first 2 pillars are about gathering information that we cannot control. I can't force the fundamentals up or down. I observe them. So they're information gathering. The next 2 pillars are where I can take action. The third pillar is cash flow, where it's about positioning. Am I going to be long or short? Am I going to be a buyer or seller? Am I going to collect rent? Am I going to collect distributions from a syndication or dividends from a stock? How am I going to position myself to have my own personal financial statement benefit in some way, whether it be by protection, income, capital gain, whatever it is? How is the cash going to flow, right, to me? Where's the cash going to go? How do I put my way in front of cash flow to increase my situation as an investor? So that's an action-taking pillar. And that's where you learn various strategies. Are you going to be a commercial real estate guy, a single-family home? You can own a trailer park. Are you going to be in stocks? Are you going to be in options? Gold doesn't cash flow, neither does Bitcoin. So how are you positioning yourself? Is it just a capital gain play like gold or Bitcoin, or is it a protection gold or Bitcoin? Those are 2 different strategies and positions to have with the same asset. Or are you going to cash flow through real estate and stocks? 4th is action taking, which is sudden change, risk management. Part of winning a Super Bowl is dealing with sudden change when there's an interception or fumble, where the field gets flipped immediately. you have to deal with sudden change and have a contingency. So risk management is by far the most important pillar. Again, your index fund has no systemic risk management, none. A systemic issue will hurt you more in an index fund than anywhere else because there's nowhere to run. You're exposed to every part of that awful systemic issue. And so index funds lack the risk management under the cloak, the guise of diversification. They say, well, if British Petroleum becomes broken pipe and they break a pipe in the Gulf and they go from 60 to 30 in 2 weeks, and you only had 1% of your money in that, you lost 0.5%. So good thing you're diversified. Yeah, but if the S&P goes from 6,000 to 3,000, there's nowhere to hide. So it's a guise of diversification, and diversification does not address systemic risk. So it fails in the fourth pillar miserably. It just does. So you're taking a lot of risk systemically when you bet on the index fund, and you're betting that there'll be a recovery before you need that money in retirement. And it generally doesn't cash flow at a rate that will sustain you. So those are the four pillars: fundamentals, technicals, cash flow, risk management. 2 of them are information gathering, 2 of them are action taking. I'd much rather invest through the prism and lens of the 4 pillars than buy a freaking index fund right now at a Schiller PE of 38, spend $38 to get $1 earnings for the year. Imagine buying a machine for $38 that's going to produce $1 over 365 days. You spend $38 to get $1. That's where the S&P is right now. I'd rather go into sectors like energy right now and say, Google's building their own power plant. Energy must be a pretty big deal right now. I'm going to get exposure to energy because it's dropped a bit. It's on sale. I'm not, energy is a better place right now than the S&P. You're going to get a lot better discounts buying a dip in energy right now because there's more value in those stocks. You're getting more for your money right now than others. So I'd rather discriminate and be educated and make those calls through the 4 pillars. Boy, that's wordy. I've been wordy today. Too much yapping by Andy today.
No, this is great because it's like I said, it's going from good, better to best, and the best is having a financial education. And to break it down into the 4 pillars, you can wrap your head around it. That's what I love about that. And so where most people are, hey, let me just set it and forget it with my money. Now I have an action plan, where I can take control of my finances. So I think that's absolutely awesome. What other 2 cents, as our producer here is wrapping us up real quick, what other things are on your mind for the average listener that's like, okay, I'm sold. I don't want to set it, forget it. I want to be better than average. What's one more thing that you could tell the listener?
Well, the thing about index funds, they certainly have some that will pay out. There's dividends that are paid in some of those S&P stocks, but your average is going to be lower than if you find some really good dividend paying stocks. You don't need. Do you know how many do you know how many companies you need to hit it big? One. Buffett talks about this all the time. Is a handful. If you'd bought Coca-Cola, you'd have been fine, right? He doesn't buy a lot of stocks compared to some of the funds. He certainly doesn't own 500 in the S&P. He doesn't own 500 stocks, not even close. And so the idea of company ownership is a good one. Now, with that said, if I could have any saving grace for index funds, if a person knows nothing and doesn't want to know anything and is happy with mediocrity, because that's exactly what it is mediocrity, it's better to be participating than not at all. And as you look at real estate, like I don't like selling real estate. Earlier in our career, we had some nice offers on some properties and we sold them for a handsome profit. But I tell you, I look at every property that we owned. I wish we had them today. I wish we'd have never sold them because they're worth so much more today than they were 20 years ago. So I got in the habit of saying, look, if I get my hands on some property, I'm not letting it go because it's a piece of the pie. There's only so much land. Well, there's only so much GDP. And when I buy stocks, I consider myself as playing monopoly in that I'm buying part of the gross domestic product of America. And I look at that gross domestic product, whatever that number is, and I want my share of it. I want to participate. So I don't like selling stocks either. The idea is to accumulate assets. Well, buying an index fund is getting your piece, a share of that GDP. It is. Is it the best way to do it? I don't think so, but it'd be better than sitting on the sideline. And a person who spent their life saving money and putting it in the bank every year from the time they were 15 years old to where they died, compared to a person that bought index funds in that same scenario, the index fund guy is going to absolutely beat them. However, if you compare that to a person who discriminately buys stocks with strong fundamentals that pays a dividend and writes covered calls, that person's going to bury the index fund guy by a mile. And so it's just, what do you want in your education? Do you love it? Do you love learning new things? Do you find it exciting to be at the driver's seat and grabbing the wheel? When I go around town, I'm very grateful that my wife will drive, because I just don't care, and I'm a big guy, and I just like sitting in the passenger side and being on my phone. But you know what? When I really want to get somewhere, my wife knows better. I say, "Honey, you want me to drive today?" And then she knows I really want to go somewhere. And there's a thrill of having control of a car and a windy road and putting the hammer down and that acceleration. I like driving. And in investing, I like driving. I want to be in the passenger side, just having someone else control it. Risk is about control. I'd rather have that in my own hands and control it. So there you go.
Very good. Very good. Well, that brings us to another into our Rich Dad StockCast. Listeners, I hope you found that this discussion on investing in index funds insightful and really gave you the clarity you need to make better informed decisions about your investments. And a huge thank you to Andy Tanner for joining us today and sharing his expertise. Andy, it's always a pleasure to have you on the show. And remember, the key to wealth is in education and consistent action. For more resources to enhance your financial knowledge, visit stockcastbonus.com. And if you've enjoyed today's episode, be sure to like, subscribe, leave us a comment. Your feedback helps us to improve and bring you more of the topics that matter to you and your family. And don't forget to share the podcast with your friends and family as well. Thanks for tuning in to Rich Dad StockCast. Until next time, stay smart, stay invested, and take control of your financial future. I'm Denney, and we'll see you on the next episode.
Thanks, Del.
This podcast is a presentation of Rich Dad Media Network.